Hi, everyone. Welcome to the Invest with Nikki podcast. I'm Nikki Rosenberg, your host, where we talk all about real estate, wealth building, and building your fire, how to be financially independent and retire early. I'm super excited today. We have an incredible guest here. We've done some really great work together thus far, and today we're going to sit down and talk all about how to invest into short-term rentals and what that looks like from the lending standpoint. Today we have Sean Bailey with Invest with Sean. Sean, welcome to the show.
Woohoo! Thank you for having me. No, this is great. I love this.
Yes.
This is great.
I am so excited Sean is here. We've been planning this for quite some time.
Yeah.
And you and I have such great conversations. Fun fact, this is actually the first time we've ever met in person.
Yeah, I know. We do, for the last 3 years, we've had all our all our conversations over the phone.
Yeah.
And we've done a lot of deals together, a lot of, millions of dollars worth of real estate being purchased and thrown around. So it's great to finally meet you, and what a great platform to be on.
Yes, thank you for being here.
Oh, thank you for having me.
So I want to know, tell me about your background. Like, how did you you're a mortgage broker. How did you get into lending? What made you want to do this? How long you been in the business? Tell them.
Yeah, well, I'll give you the long story short, short story long. Used to be in the restaurant industry. Got married, had a kid. Restaurant industry became very tough. And one day, it was a week before Christmas in the restaurant. I was working in the kitchen, managing restaurants. And I called my wife as soon as I walked into work, and I said, "Are you cool if I quit?" And she was like, "Do we have a plan?" I was like, "We've got a $25,000 credit card limit.
Yeah.
We'll figure it out. But I can't do this anymore." I had a 1-year-old at home, and just forced myself into anything other than the restaurants, and sold life insurance for about a year. Got my license there, and just networked my way into somebody saying, "Hey, you need to get into the mortgages and become a licensed loan officer." And that was during the refi boom of COVID and all of that. So it was 2020, 2019. I kind of started in there and worked my way through the refi boom, which is great. Yeah. I learned a lot. I was drinking, through a fire hose. And when the refi boom stopped, and 8% interest rates, and there was no more refining, the industry kind of got cold, and I switched from the primary home side into investment lending because they kind of seesaw each other. They teeter-totter. So when the primary home side slowed down, the investors flooded the market with buying up rentals and buying fix and flips, and the housing, the property values soared through the roof. So investors were just flooding the market. So I jumped on that ship, became a hard money lender. I did a lot of loans for investors, and I kind of saw how easy it was that they made money. I saw these Airbnbs being built from nothing, and I'm like, whew. And slowly kind of said, hey, I can do this myself. And kind of plugged myself into the industry, networking appropriately. That's how I met you. And so on and so forth. Now I'm here. So I've done over $200 million worth of loan volume in the last 2 years of funding, and really helped a lot of investors make a lot of money. And I love what I do.
Yeah. And you're an investor yourself.
Yeah. I have an Airbnb. I have a couple rentals. I've fixed and flipped a few properties. I've failed significantly in this world, and being in the trenches of knowing what it takes and what it is to be in there, and knowing the lending side, like the back of my hand, it kind of helps. Yeah. Where now I help a lot of investors kind of learn that whole side of the world, because once you know the lending side, it can really take off for you. And if you utilize it correctly, you can be super successful on the investing side. So.
Absolutely, because then you really start to understand the underwriting and what the lenders require, and how you can really set yourself up to exit what strategies you have there. So and I know we've done a ton of deals together, and one thing I love about working with you is you take a consultative approach, a coaching approach, right, to every single client that we've worked together on. And to me, that is how I like to run my business too,
Yeah.
with my real estate business, my management company, my own investing, is like, you're looking at the big picture. You're looking at the whole,
Oh, yeah.
how can you serve that client? It's not just about getting the deal done, right? It's like really about like advising them and educating them, right?
Yeah. And, I've learned that in the beginning. That's kind of how I've been in my whole life is, we build relationships. You don't build a business by just taking money from somebody. There's a lot of lenders out there that will underwrite a deal and say, hey, look, this pencils, let's just go ahead and go and let's make it work, and not explain the process to you and make sure that you are mentored, as a first-time investor or flipper or a short-term rental investor. Like, there's a lot of things behind the scenes that have to fall in place.
Absolutely.
And if those crumble, you could fail. And if you fail, I'm not going to get another loan from you in the future, So at the end of the day, like, I need you to be successful for me to be successful. And it's not all about just pushing paper and making money. It's about helping people grow and build their fire.
Yeah, build their fire. I love that.
Yeah.
Love that. So what's the biggest misconception people have about financing short-term rentals?
This is a great question. The biggest misconception, I think, is different for everybody, but the largest thing that people come to me about is getting bamboozled by the bait and switch tactics from hard money lenders or from other direct banks or however it may be. They shine or they dangle the carrot in front of you and saying, hey, your terms are going to be 5% interest rates and 0 points and 30-year fixed. And they kind of they give you the sticker shock, or what's the word I'm looking for? They give you the shiny wrapper syndrome of like, hey, look how awesome this product is.
Shiny object, yeah.
And then they're like, oh, hey, this makes sense. It's great. I saw this ad on Meta or TikTok or whatever of, oh, I can buy a house for $0.
Right.
And then they actually go with that lender or they go with the financing and they realize, oh, they just bait and switch me. Oh, I went from 10% down to 20% down real quick. Oh, my interest rate went from 5.99 to 7.5.
Right.
And that's the biggest misconception is trusting and knowing your lender and having that, doing your homework and your research on the lending before you just get in bed with a lender.
Right. Every time I do a deal, the lender is, if it's not a good lender, and sometimes I don't make that decision, especially when I'm representing my clients on the real estate side, I try to advise them, but sometimes they come with their own lender, and I'm always so nervous when I go into a deal with a lender that I don't know, because almost every time it always ends up falling apart. And that's why it is so critical to have, someone who really understands. Like one of my recent deals that fell apart is, almost all the properties that we buy and sell are investment properties, and they were buying a non-warrantable condo in the Orlando area.
Condos are dangerous.
Yeah, in the Orlando area, right near Disney, and the lender didn't even know that they don't loan on non-warrantable condos. It's like, they've obviously never touched an investment property, because you would absolutely know that going into the deal if you had experience in investing in condos. You would know that. That would be your first thing of like, well, this is a non-warrantable condo. Now we have Fannie and Freddie aren't going to buy this. So there's that experience is so critical, because guess what? That client lost their EMD because they used their lender that I didn't recommend, and they got to the closing date, and the lender says they can't do it at closing date. Like, how did you not know 30 days ago that you couldn't do this, right?
And that's the bamboozling I'm talking about. No, it's an unnecessary, bait and switch is a hard term to use, but it's, hey, we're at the closing table, and now you're telling me we can't do this because of an oversight.
Right.
And that's where, in the investment space lending, it's so much different than your primary home, your FHA, your VA, your conventional Fannie Mae, Freddie Mac product. We're not using any of those products.
Nope.
We're all non-QM, which is a non-qualified mortgage product. So yes, every lender, as a broker, I can pivot between lender and lender depending on everybody's situation. And that's why I think brokers are so important compared to a direct bank, where, every client that I use, or any client that uses me, I put them with a different lender based on their specific needs, whether it's credit, whether it's down payment, whether it's short-term rental, long-term rental, whether it's a fix and flip, whatever it is, everybody's got their own home on the lending space, and that's why we have to put you in that specific spot. For instance, the condo situation. I have a very nasty story about a client buying a condo cash without lending and didn't do their non-warrantable check. They bought a condo in Jacksonville, fixed it up, went to go sell it, and they couldn't sell it because it was non-warrantable. So none of the home buyers, your buying pool of anybody, first-time home buyer or wherever, it was on the beach. It
Was that a short-term rental allowed community?
No.
That's why he couldn't sell it.
Well,
because now he's got this investment property, which is a non-warrantable condo, that they don't allow short-term rentals. That's a whole other episode about HOAs banning short-term rentals.
Yep.
We'll dive into that another time.
Yeah.
But, now they're sitting with a property that they can't sell.
They lost, I think, $75,000 because they sold to a cash buyer.
Right.
And that was the only person that could buy it because no lender would loan on it, even on the non-QM rental space. So even on using an investment loan, there's still lenders that won't lend on non-warrantable condos within certain guidelines.
So can you break down for everyone, everyone listening, they're all at different levels. Can you break down a non-QM versus, more of a traditional type of product, like a conventional loan? Can you explain that?
And that's a great question. So a QM loan or a qualified mortgage is going to be your Fannie Mae, Freddie Mac, FHA, VA, USDA product. Those are all backed and regulated by the FDIC, HMDA, RESPA. Those are all your licensed loan activity. In order to get a QM loan, you have to have a loan officer or a bank that is licensed on the NMLS. So there's testing, there's regulations, there's laws, there's TRID. Those are
TRID?
You got me.
All these acronyms.
I know. Sorry. I should know what TRID means.
What is it, though? I mean, if you don't know what it means.
So TRID just means that we have to follow guidelines for the buyer to have time to know that they're not peer pressured into a decision.
Yes.
So your 3-day wait period.
Right.
So whenever you buy a house, we have to disclose a loan estimate on application. We have to disclose in 3 days to show you, hey, this is what we're offering you.
Right.
And then the same thing with the closing disclosure. You have to sign that closing disclosure 3 days before the purchase, so you know that those are the final terms. And if anything adjusts in that closing disclosure, we have to send a new one, and we have to wait 3 more days. So all of you sellers out there and home buyers who have been hurt by the TRID guidelines of, hey, we can't close today because I didn't sign the CD until yesterday.
Right.
It's because there's a 3-day rescission period that allows you to say, hey, am I making a mistake here?
Yeah.
Like, I just was told the final terms, my total cash to close, the interest rates locked in and finalized. Is this something I still want to do? And I guess, that regulation is they give you 3 days to think about it.
Right. But you don't have that on non-QM.
Non-QM, no.
Yeah, so
we
let's
don't
talk
care.
about non-QM.
Yeah.
Tell them.
So,
give them the goods.
Non-QM is, it's a heavily investment space.
Yeah.
There's no TRID guidelines. There's no licensed activity necessarily. So we don't have to follow all of the RESPA laws or HMDA. There is still that regulated by every lender. I mean, they're still going to play ball in that regard, but it's not required.
And they have like their private parameters of what they follow within their lending guidelines.
Correct.
Right.
And that allows every non-QM lender to kind of make their own rules. So every lender is going to have different rules. One lender on a non-QM product may say, hey, we'll do non-warrantable condos for you. And then another lender says, hey, we do non-QM, but we will not do non-warrantable condos. So that's why it's so important to kind of know a broker that deals with, a handful of great lenders directly, so that they can put you in the spot that you need to be in. If you have a non-warrantable condo, why is it non-warrantable? There may be a lender out there that will do it. Non-QM lenders will allow you to get into properties, investment properties, without like heavily regulated rules.
Yes.
And they have just different, better, easier guidelines to get in.
Yeah. And I always explain to my clients, and we're going to get into the different loan types, but, a lot of the non-QM products, like a DSCR loan, for example, a debt service coverage ratio loan, they're looking at the asset. They're loaning to you based on the asset, and can you service that debt versus me as the individual of what my income is. And so, you know, a lot of times when I'm consulting with my clients, it's like, okay, let's talk about your personal financial, you know, scenario. You know, what type of income do you have, and you know, how do you get paid, right? Are you a business owner?
Yeah.
Are you a W-2
Self-employed.
employee? You know, yeah. How are you getting paid? Because that is huge. You know, and almost all my investors are doing the non-QM products, right?
Yeah.
Because it's really about that asset and how that asset can perform. And of course, when we're doing deals, we're finding assets that are going to perform.
Yeah,
You know, so people are getting, you know, they're able to qualify for that DSCR product, or other products that are really based on the asset. So before we get too much into loan types, I want to know what client changed the trajectory of your career.
I kind of started when the refi boom stopped. I got into the non-QM space, and I started just lending there and trying to shake hands and kiss babies, networking, and it kind of started slow. And there was another broker within my company that had probably 8 Airbnbs and worked and got into a group like host camp from Rob built. He's a big guy from Rob Abasolo from Bigger Pockets. And he signed up for his host camp. He had STRs and kind of got with Rob and said like, hey, I'm a lender. Let me start lending on your clients. Like, let me be the preferred lender for your boot campers. And he started getting a huge influx of leads, and he didn't really know the products as well as he dug himself a hole real quick.
Right.
And nothing bad about him, but he needed help. So he said, hey, Sean, you know a lot about non-QM products. Can you help me with this lead flow?
Right.
And I learned real quick with, you know, drinking from a fire hose with all these clients from Rob that, you know, he's a short-term rental specialist on the Bigger Pockets world. So I learned a lot of niche products where he's like, hey, go ahead and carve out a hole into a rock in, you know, Arizona and make it an Airbnb. Or throw
like
some
a cave?
Yes. Sure. Hey, throw shipment containers up in trees and we'll make a treehouse jungle in Texas. Hey, I'm gonna
need that link.
Yeah, for real.
A shipment container treehouse?
It's insane.
What?
You know, somebody got 20 shipment containers.
That.
Yes. And so I was dealing with phone calls of like, hey, I got these shipment containers. How do I fund this deal? Hey, I got all these geodomes. Hey, I got this house in a rock. I'm not making these things up, these scenarios up. These are all real. And trying to get all these people financing, I learned real quick, like, hey, it's very, very challenging.
Yeah.
And in that scope, though, in that world of trying to find financing for those niche, crazy products, I found a lot of good lenders that do other things that are close. I mean, you're not going to find somebody that's going to finance a rock.
Yeah.
You're just not.
So did you help them buy the rock?
No, I couldn't. I can't help. I can't help you buy the rock.
You can't,
and I couldn't
buy a cave.
Yes, and I also couldn't help the shipment containers in the tree houses. But
yes,
you know, that also just opened up the conversation to meet capital investors and how to build capital yourself and kind of do that space. And it's easier to refinance those deals. You know, like A-frames or geodomes. It's easier to refinance properties once they're complete because we have a book of business or a cash flowing property, then the debt service ratio can kind of make sense. But
yeah, it's already proven, right? It's a proven business that you can sink your teeth into, right? Like the lender goes, oh, okay, there's proof here. I can now, I'm fine with, this reposition because I can see the proof in the pudding, right?
Exactly. It's like, hey, we converted this B-52 airplane into a Airbnb resort out in the desert. I need to refinance it. I'm like,
yeah.
Okay, it's not. Does it have an address?
Yeah.
Like, does it
have an address?
Yeah. Is
as
it
coordinates
affixed to foundation? I'm not sure a lender will still lend on, a converted airplane. But there are some non-QM space out there to say, okay, well, let's see what the book of business says. Let's see what the proven profits are, and it's easier.
I mean, essentially, you're stepping into almost like commercial lending. You're buying and selling businesses, right?
Yeah.
Even though what I specialize in is those short-term rentals. A lot of what I'm doing on a day-to-day basis is helping someone buy an existing business and improve it, or launch the business. And it's the same thing that you're really doing, right? On the lending side is you're analyzing, okay, is there a book of business here already? What does the revenue look like? You know, what is the cap rate? What is the cash on cash? What is the overall return? You know, you're looking at all that. And so it's interesting because, you know, what we're doing every day is really just about buying and selling businesses with real estate attached to it. Right. So it's more in that commercial world, but we're kind of in that weird middle space, right, of niche. I mean, you do it all, but
yeah.
All right, so I want to talk a little bit about today's market. There's so much headlines out there, the market is crashing.
Oh yeah,
you know, just all the crazy stuff. Do you think the market's crashing? Do you think that investors are being priced out right now?
Oh man, I'd like to plead the fifth. I mean, every day I take this phone call of, hey, our interest rates, where are they going to tank? Hey, is the marketing industry? Hey, I'm not gonna buy right now because I'm waiting for a year when, you know, the $400,000 home comes to $200,000. It's like, no, that's not gonna happen. You know, and just a real quick point on that, you know, the U.S. government just got approval to print a butt ton of money coming next year. So inflation is gonna go way up, and that's not gonna help home prices. Everything's just gonna get more expensive, and that's just how inflation works. So no, housing market crash, no. That's why I don't want to be that lender that's like, oh, buy now. But every year that goes by, it's like, oh, I should have bought. Just like the Bitcoin thing. I should have bought Bitcoin back in 2015.
Right.
I should have bought it last year. It will ebb and flow. But at the end of the day, historically speaking, real estate has been the number one investment that will continue to appreciate.
Absolutely.
So that's my opinion on the market crash. Whether you buy now or later in 10 years, it won't matter, because it'll all appreciate.
What are you saying right now? Like, I know you work with a lot of investors.
Yeah.
So what are you seeing right now in the market? I know this is very market specific, but if you had to generalize, because, you know, our listeners are everywhere, what would you say in general you're seeing happening with the different types of investors and different types of deals?
Yeah. You know, obviously the housing market has cooled off nationwide. Some markets are still hot. Some markets are ice cold. And investors are still driving the market. I mean, every deal, there's a deal in every deal. Meaning, if you underwrite it appropriately and you pencil it in, every house, every investment can make sense at some point. The question is, how are you getting your entry? How are you sourcing those deals? I think your question was like, are investors getting priced out? Are they adapting to the environment of the real estate industry? The ones that are not adapting are getting priced out. Yeah. Self-sourcing your deals, whether it be for short-term rentals, whether it be for fix and flip homes, whatever the investment is in the real estate space, you're going to have to start self-sourcing, networking, shaking hands, going out there, meeting the people, meeting the community. If you want the sweet deals that all these wholesalers are getting, how wholesalers are making all this money, you need to go cut the middleman out. In my opinion, wholesalers are ruining the market for investors. They're great people. They do make investors money, but they are tightening the margins to making it so much more difficult. So the real investors in my book of business are also self-sourcing. You know, they're still finding the huge, large margin flips, the huge, large margins to convert to rentals. And that's super important when you're doing the BRRRR method. Of you have to have a large margin. And if you're not self-sourcing that deal, a lot of times a wholesaler eats that margin up.
Right.
So
wholesalers are not investors,
correct.
Right?
Yeah.
So if for anybody that doesn't understand what you're saying about the market, can you break down for them like what a wholesaler is and how do they fit into the puzzle of these real estate deals?
Yeah. And I'm not going to sit here and talk poorly about every wholesaler. I love my wholesalers. But here's how they're affecting the investment space. Just like when the refi boom happened and that stopped, the investors flooded the space on real estate investing. And what a wholesaler does is they just sell paper. So they find the deals for you and then they kind of broker them out and find an investor to help the distressed buyer, whatever it may be.
They write a contract on the property.
Yep.
They lock it up.
Yep.
They make it assignable.
Yep.
Right. And then they go and they find the buyer.
Yep.
And then they take a nice big fat
whatever
fee.
the difference is on those numbers.
Yeah.
They take that and put it in their pocket.
Right.
So yeah, at the end of the day, in a quick scenario of numbers, let's say there's a distressed seller that needs money quickly. The wholesaler was able to source that deal and find them and say, hey, I'll buy this house for $100,000. The seller says, oh my goodness, thank you so much. I would love that. I know my house is a wreck. The roof doesn't work. The bathrooms are all, disheveled.
Right.
There's no way I can sell this on the market. It's probably worth $300,000-$400,000, but in the current condition, and the wholesaler's playing to that a little bit.
Right.
But hey, you need money now? I'll get you the money now. And the wholesalers have a book of business for buyers.
Yeah.
And they know they can sell that property for $200,000. And they can go to the investor and say, hey, I have this awesome property. It's $200,000. All you need is about $75,000 worth of renovation costs. Put a new roof on it, shine up the bathrooms, put a new kitchen, and it'll be worth $400,000.
Right.
Now, on the investor side, if the numbers pencil, the numbers pencil.
Right.
Hey, $200,000, $275,000 all in with the rehab, $400,000. There's a $125,000 gap. Take out your expenses, probably 25% expense ratio, whatever it may be. Hey, I'm still making $50,000 to $60,000 on that flip.
Yeah,
that makes sense.
Right.
Which is great. So that deal still makes sense. Now, what did the wholesaler make? The wholesaler locked it in at $100,000.
They didn't have to do any renovations.
And they didn't do any, and they did it in 3 weeks.
They don't have to put up any of their own money.
Nope.
Which wholesaling is great. I mean, I have clients that wholesale. Me being a Florida realtor, like I bring deals to people. So like I respect the hustle. I know how hard it is to find deals, source deals, negotiate, get things locked up and then move those deals, right?
Yeah.
It's a lot of networking and just a ton of logistics, right? Of you got to have speed, you got to have hustle. So I totally respect it. But I do see, how that wholesaling world is just continuing to build. And, if you're not smart and you're just starting to grab wholesale deals that don't have a lot of meat on the bone, you've really got to make sure you know your numbers. And that's what I love about you is you do those fix and flip loans. Yeah. So you're really able to help coach people when they come to you and they bring you a deal. You're able to underwrite and help them understand if that's a good deal or not. So you're not just like, let's get this deal done. So we talked about a little bit about that already, but
of course.
Yeah.
And that's where, wholesalers are great because at the end of the day, they, as an investor, they put you in front of a property that does show promise to make money.
Right.
And 3-4 years ago, wholesalers figured it out pretty quick.
Yeah.
TikTok blew up on some guy being like, hey, look, I made $50,000 by just signing a piece of paper. And next thing you know, mentorship courses are being sold. Yeah. And everybody's learning how to wholesale, just like in any industry.
I still buy wholesale deals. I actually bought 2 properties this year, short-term rentals from wholesalers.
Yes.
So, it's crazy because I'm a deal finder myself. I know. But I bought it from them, and guess what? They made $100,000.
They're
on
great.
each of those properties, but it still made sense for me.
It still made
complete sense.
Right.
So I love what you said about self-sourcing.
Mm-hmm.
I think it takes a lot of time and energy to self-source, but like what you said, if people are just really meeting people, talking to people, getting out in the community, networking, they can absolutely find deals. And you can also go to realtors that are familiar with investment properties. Not every realtor delves into that world, but a lot of realtors are going to know someone that's distressed or someone that could use selling their property off market distress, like something that needs some love, right? All right, so let's talk about, we talked about the market, we talked about wholesalers, we talked about fix and flipping, we talked about you and your business. I want to talk about short-term rental specifically. What type of loan products are we using whenever we're buying short-term rentals? How do we invest in short-term rentals? How do we set ourselves up? What type of products should we be bringing, whenever we're trying to get those deals done?
Yeah. There's a lot more products out there that I think people are not aware of. DSCR is kind of the quick answer for a lot of those. This is, a debt service coverage ratio loan. Hey, does the property pencil? Meaning that we don't need your W-2s, we don't need your bank statements, we don't need to see any income. The property makes $2,000 a month in long-term rents. The mortgage payment's only $1,500. You're approved for the loan. But there's much more than just DSCR. As the market has adapted and housing prices increased, the loan amounts increase and the interest rates have increased, which makes those approval, I guess you could say the approval ratings on DSCRs way more challenging. Lenders have tightened up their guidelines and saying, hey, we no longer need you to be at 1-to-1 ratio. We need you to be at 1 to 1.2, which means you have to be 20% profitable on each property. Now, that's not with everybody, but
whereas before it was like 10%?
No, before it was you don't need to profit at all. You could just be 1-to-1, meaning
okay, it just covers it.
It just covers it. And there are still lenders out there, by the way, that will do a negative DSCR ratio loan.
Oh, I wasn't aware of that.
Yes, which is crazy, right? It kind of makes you go like, what are we setting ourselves up for here? But those are specific to the knowledge of like, okay, the negative cash flow loan approval is based on a long-term rent. And they usually allow those if they're becoming a short-term rental, because short-term rental income is going to be calculated different than long-term.
Right.
But how they underwrite their guidelines is based on long-term rental income. So that's how they allow for it. But they're outside of the DSCR loans, because of what I found is it's been more of a challenge to get them approved. The leverages are getting higher, which, before 2-3 years ago, it was like 15% down is all that's needed for a great interest rate. Now, if you want a good interest rate, you got to put 25% down.
Right.
And home prices have gone up.
Right.
So loan amounts gone up.
You're bringing a lot more cash to the table.
Exactly.
Right.
So one of the big products that I'm using right now with a lot of my clients, and I kind of try and I don't want to say the word steer because that's sounds bad, but I want to
you advise them.
Advise them.
This product's a good product.
Yeah, the bank statement loan.
Yeah, we were doing one of those together.
Yeah,
my deal fell apart, but that's okay.
Hey,
they happen.
The house has to appraise, right? And that's another.
Didn't appraise.
That's another talking point.
Yep.
But yeah, the bank statement loan is a lot of these investors, a lot of you investors out there probably, as do we on our taxes. We probably don't show.
I don't show nothing.
Right, we write off everything. As
I buy short-term rentals, so I can legally pay $0 in taxes. And you guys are going to learn more about that as we get into more episodes of the show.
Through this podcast. It's great.
Right.
And, I need to learn more about that too.
Yes.
And kind of, and here we are at the end of the year.
Yeah.
And you have a lot of investors, and I have a lot of bank statement loans right now.
We do.
Because they're trying to buy by the end of the year to be able to get that tax benefit.
Yes.
So bank statement loans, it's a blended kind of combination of, we do use the rental income of the property in with your bank statement income. So your bank statement income is calculated by how much money are you bringing in per month. Some investors, and it does that business, by the way, being self-employed, does not have to be in real estate. Doesn't have to be in short-term rentals.
Any business.
Trucking companies.
Basically, if you got money coming in your account, that's all they care about.
If you got
and they don't care about where it's coming from. Right.
If you got a cleaning company and you're just taking Venmo, or a landscaping company and you just got Venmo money coming in, they don't care.
Yeah.
There's a relative speed. It doesn't have to come through any sort of large sourcing company or a payroll company. It's what money do you have coming in, and is it consistent?
Yeah. What are you getting every month consistently? Right. You can't have these huge spikes and then drops and expect for them to be like, well, we really trust that you're going to be able to cover the loan.
Exactly.
Right.
So, they take a 12-month, sometimes 24-month worth of your bank statements.
Right.
And they take the average, and that's how they get your monthly income.
Yeah.
There's a client that I just got pre-approved last night. He owns a bounce house company. Okay. Very low overhead. Just pays an employee to go set it up. Very little money, and then he's got his initial expenses on the bounce houses. Yeah. But he's bringing in $30,000-$40,000 a month.
Go ahead.
Which is
That's great.
Right. Shout out bounce
On
houses.
Some air
where
and
it's at.
some plastic.
What are we doing?
How to make 50 G's a month with air and plastic.
What are we doing? But on his taxes, he's capable of writing off a lot of expenses. So he can't buy an investment property using his income.
Right.
And the property that he wants to buy won't pencil on a DSCR loan because of the Airbnb. It's not an Airbnb location.
Yeah.
And it's
so you don't have comps to pull from.
Correct.
So let's talk about this.
Okay, go.
So I remember, you guys are going to learn more about me, but I worked for a company that has now sold. It was the biggest property management company in the world. I'm not going to name names so everybody knows it. But back then, this was pre-COVID and then going into COVID, okay, 2019, 2020.
The golden age.
I could not find lenders that would do loans with these short-term rental projected income. They just wouldn't do it back then.
Yeah,
they were like,
exist.
they would totally do it for long-term rentals, but they would not do it. So this is like fairly new. I mean, in the last 5 years, that lenders are now, they're essentially,
Adapting.
they're adapting to what people are demanding, and people are highly demanding for short-term rental properties.
Yeah.
Mostly because the tax advantages are crazy, especially now that Trump gave us the big beautiful bill. Thank you, Trump. Because now, they can take bonus depreciation, they can accelerate depreciation, and, now the lenders see like, okay, there's such a demand for this. We're going to now learn how to calculate the income for these short-term rentals. So they're using AirDNA, they're using Rabu, they're using, maybe key data, but they're pulling comps for short-term rentals, and they're looking at, okay, what's the actual revenue been on these comps? And they have a lot of different guidelines about how they do that and what they'll accept. Like I've noticed some lenders, like when they're pulling comps, like they'll only take the actual bedroom count, not the occupancy count of a property. So there's like all these kind of different variables. But now it's so crazy to me. And I've actually seen, like actually on my deals that I personally bought this year, the appraiser that they use, because they have to validate short-term rental income. The appraiser does, right? And these appraisers are now actually learning the niche of the short-term rentals, and they're actually, completing the appraisal for short-term rental. I don't know if you've actually done any of those where the appraiser is trained.
Yeah.
And can you talk a little bit about that?
Yeah. No, I have a lot of lenders that won't use AirDNA, or they won't use.
Why?
Because it's that's not the niche that they've gotten into yet. They haven't fully adapted into or trusted the process.
So they just don't feel comfortable with that data for some reason, or were they long-term lenders before, like long-term rental?
Yeah, they could still do your DSCR, and they still will calculate your approval based on long-term rents.
Gotcha.
And because they sell these loans on the backside to other investors, there's a risk analysis and there's an underwriting team that goes beyond our wildest dreams of like what they're allowed, and there's a risk analysis behind there. There's a trial period where nobody wanted to be the trial, the hamster. So but what they did shift to is saying, hey, we don't care if you use short-term rental income analysis. It just has to show up on the 1007. The 1007 is, you have a 1004 and then a 1007. 1004 is your normal home appraisal. So that's just the form name for your home appraisal.
Right.
Comes in appraised. The appraiser goes out there and says, hey, here are the comps.
Check the boxes. They fill out the form. Right. Okay.
Yep. And that gives your home value.
Right.
On the 1007, that's a market rent analysis spreadsheet, which does the rent income for the area. And an appraiser goes out there and says, hey, this house, and this house, same square foot, bed, bath, same kind of style. This is what it's renting for. They pull those comps off the MLS. Then the lenders have said, hey, as long as that 1007 shows whatever number it needs to be, we will use it. Meaning if the appraiser uses the short-term rental income analysis on the 1007, we're fine with that. We have a document that says there's a nightly rate, and appraisers can evaluate each property on a nightly rate schedule as opposed to a monthly schedule. And the lenders are like, hey, as long as they're putting a nightly rate on there and the 1007 says, $5,000 a month as opposed to $2,200 a month on long term, we're fine. We can use that document. The challenge, what I found, Nikki,
Tell me,
is appraisers.
I know that. Well, I personally know. I literally just lost a deal myself that I wanted so badly.
Yes.
And because of this appraiser. So What is it that is it?
Appraisers are the death of real estate.
I need to get an appraiser on the show because is there like an appraiser ego? Like, is that a real thing?
Yeah,
you got one?
Yeah, good. Yeah. I mean, I also have a lender that we can choose our own appraiser.
See, that's where it's going. And a couple of the deals that I did, this year, they have like their people that they know, they're trained for short-term rental. They know how to analyze the market. Like they're on your side in a sense, right?
They don't like killing deals.
Right.
And appraisers get a bad rap. Of course, I just said they kill all of real estate and they're the death of real estate, but they're not. They're they're the backbone of it. And they do have a very important job that's licensed, and that's why, to jump back on having the biggest challenge of the short-term rental analysis on the 1007 is your appraiser, because it's technically, to some appraisers, against their licensed activity to show nightly rental income analysis on the 1007, because the 1007 specific fine print is requiring long-term rental, even though there's some line items that say nightly rate on there. Some licensed appraisers,
it's gray area.
Some licensed appraisers go, hey, I'm not going to risk my license to put on short-term rental income or nightly rates on the 1007. I'm only going to do long-term. And it's like, okay, well, you're not playing ball with us. Hey, this is a non-QM loan. This is a non-licensed loan.
Right.
You're not going to be. This is not going to affect or put you in jeopardy. And I'm not going to be the one to like tell any appraisers. I don't talk to appraisers. But at the end of the day, these are non-QM, non-licensed loan activity. Their license as an appraiser isn't going to be held in jeopardy by Fannie Mae, Freddie Mac, or any of the QM lenders where they're going to be held liable for, appraisal fraud or mortgage fraud or anything like that. And I do want to take a quick disclaimer here that there are, when you can choose your own appraiser and with certain lenders and you can use those values. Please note that doesn't mean you can just call your appraiser and just automatically get a higher valuation for your home.
Right.
The perk of having your own appraiser is to know that they're your teammate on your side and that they're going to be able to perform, a true value of the property of a local native, that somebody from out of town, if you're getting somebody in Ponte Vedra to appraise a home and they live in Nocatee or they live in Yulee and they're coming down to do it, they have less of a true value of like what that home really is.
That's so true.
And that can really hurt a lot of clients.
Right. It's so market dependent. And, that's something. I'm in some masterminds for hotel investing. And there's a lot of conversation in there about the appraisers, because
especially
very few appraisers know how to appraise a hotel. And that's what I find, like in the hospitality world with the short-term rentals, it's just such it's not a new thing. I mean, we're in St. Augustine. You guys see the beautiful Lightner behind us, Florida. This has been a vacation destination since Henry Flagler developed this in the 1800s. So, I mean, vacation rentals, short-term rentals are not a new business, but it is a new business when it comes to lending and underwriting. And so there's just so many variables there. And I definitely want to have the appraiser on because I want to learn.
He's and that's the thing is I've had appraisers blow deals up.
Right.
And with investors trying to refinance into their BRRRR and reposition and a home value comes in at $250,000. We were anticipating $325,000.
Right.
That's like, whoa.
Right.
How did this happen? All right. Well, we can't proceed with this lender. Let's go try another lender.
Because tell them like what happens when your appraisal doesn't come in, and let's say like I just did one, right? Like the sellers wouldn't budge. It came $65,000 too low. Yep. So what happens whenever that?
Yeah. So when on the purchase side, like yours. If it comes in low, you have to have that negotiation with the seller.
Right.
Hey, I would say probably 50%. It's a 50-50 shot that appraised values come in right on purchases now. Back in the day, it was like guaranteed right on the dot. Sometimes you'd actually get more equity than what you're, depending on the market that you're in. But on the refinance side, appraisers could kill a deal. And it's no longer we can't negotiate with the seller because you are technically the owner. So you can't negotiate any price point.
Yeah.
The appraiser just told you what your fate is.
Yeah.
And unfortunately, when that happens, there's two options. One, relist it, try and get it off your plate. If you can't refinance it. And some of those, and I say that because they're refinancing to pay off a hard money loan.
Yeah, like a lot of the people that buy it for fix and flips you're talking about. Yeah.
Yeah, they have a deadline and they have a timeline to get out of this hard money loan.
Yeah.
And if it doesn't appraise, and they got to bring more money to the table on a refinance. I have a lot of clients that are having to bring $10,000, $15,000 more to the table on a refinance. So they're dumping more money into their investment. That's the only way to get it refinanced because of leverages. You know, really the max leverage you can get on investment properties is 80%. So if you're...
It's higher on primary, right? Like 90?
Yeah, if you're doing a primer...
85, 90?
That's a gray area. VA can go up to 90%,
Okay.
but typically, 80 to 90%. 80 is usually the cutoff for.
Right.
But primary you can typically get higher leverages. Investments, it's usually a pretty hard stop at 80% max. And then you still have to qualify. It's not easy for 80%.
Yes.
Which is why bank statement loans make it easier to qualify for 80, as opposed
Yeah,
to
we're loving
DSCR.
those bank statement loans.
Yeah, I love them. They're great.
I just want to touch on that. So I had a client that I referred to you, and he had never heard of the bank statement loans.
Yeah.
And
Talk about
yeah.
Okay.
And it's crazy how much it opened up his ability to invest, you know, because he was like, wow, I have this whole product that because I have good income, you know, and he's a business owner, so he doesn't have any, you know, W-2 income. He doesn't show income on his taxes, right? Because he's smart, he's strategic.
Yeah. Yeah, and you can bleep his name out, by the way, so this will be interesting. But I will talk about his financial situation so he doesn't know we're talking directly about him, so bleep his name. But, yeah, he shows on his tax returns, like, maybe I shouldn't talk about it, but he shows, like, a very large negative income on his taxes.
Right.
Now, he's an Airbnb.
I think he has, like, 40 doors right now.
40 doors.
And we've bought together, like, another 4 this year.
Yeah. He had 70. He sold off 30 in March. And now he's just reinvesting all that 1031 exchange money into new luxury, you know. Yeah. You know, took 30 doors off his plate, and now he's, you know, financing him into like 10 really awesome doors.
Yes.
But yeah, his because it's a short-term rental game, the big beautiful bill, and how you can depreciate these properties and the STRs and the huge tax advantage you can get from those. He made less than, like I said, a negative income on his taxes. Right. Couldn't buy a primary house, couldn't buy anything with his returns. Never heard of a bank statement loan. We calculated his bank statement income.
Right.
$250,000 a month.
Nice.
Yes. So that's ridiculous. I mean, you're talking massive income.
And whenever, remind me of what the ratios are. So you have let's use a smaller number. Let's say you have 50,000 a month coming in on your bank statement. How is that looked at? Like, what's your buying power?
Yeah. So if you're generating a business that's creating anywhere, I mean, whatever it is, $50,000 a month, let's use that number. It depends on what your job is and how the lender will calculate an expense ratio. So if you own a bounce house company, your expense ratio is probably going to be calculated around 10% because there's not a lot of overhead.
Right.
You only pay one employee.
Right.
That's it. You're paying labor. Short-term rental or a property management company, very low overhead. They don't take into account the mortgage payments.
Right.
You know, they don't look at that overhead. They're looking at the management and cleaning expenses. And I've had STRs, property management companies, come in at, 0% expense ratio where we can use 100%.
Oh, wow.
Yeah, because
so that's a preset number with the lender. Like, let's say, like, I'm in real estate. Like, it's a preset
to a degree
expense ratio.
Yeah.
Okay.
So
they're not looking at my actual expenses.
No.
Right.
No. So there, you could be a restaurant owner.
Right.
You're going to be probably knocked at like a 75% expense ratio. A lot of expenses, food cost, liquor cost, labor cost, really there's a 25% overhead. They look at like industry averages.
Gotcha.
But like if you have an LLC that is a property management LLC that's owned by you, that doesn't hold the mortgages, on these STRs. So your homes are held in a holding company for the properties. And then you have a property management company LLC. Your property management company LLC is not responsible for the mortgages.
Right.
So your expense ratio is 0.
Right.
You only have to pay, nothing.
Right.
You're just managing properties.
Yeah.
And whatever money comes into that property management account is what you're responsible for. So it kind of depends on how you organize your LLCs and your businesses and the way to get the biggest outcome. But yeah, the expense ratio is going to be somewhat dependent. I've had trucking company owners have a 50% expense ratio. I've had short-term rental owners 0%. I've had bounce house 10%, landscaping companies 10%. So we can really maximize all the income that's coming in.
Yeah.
Even if it's not really there.
As long as you don't own a restaurant. No, I'm just kidding.
Yeah. Restaurants are tough.
It sounds like.
But yeah, so then on the $50,000 worth of income coming in, back to that scenario, let's say it's a bounce house where they only calculated a 10% expense ratio, where we can use 90% of that 50,000. So that gives you $45,000 a month of your that's your monthly income now.
Right.
So then we'll just compare that to pull your credit, your liabilities, your truck payment, your house payment, whatever else you have on your normal debt to
personal,
on your personal stuff.
Right.
Now these loans will vest in an LLC.
Right.
They should not show up on your personal line of credit, but as a personal guarantor or credit sponsor, that's how you qualify for this loan.
Yeah.
So then we're comparing your personal liability debt against your $45,000 a month income,
right,
plus your new mortgage payment. And then with these bank statement loans, a huge part of this too, which helps a lot of people may hey, I only make $5,000 a month in income. That's fine because we can still use the rental income analysis for the home and add it to your income. So that's a huge thing that people forget about is okay, well, that's going to take 80%.
Wait, run that back.
Yeah.
So say that to them again.
Yeah. So bank statement loans can actually you can qualify for a bank statement. I know we're talking large numbers, $250,000 a month, $50,000 a month.
We talk small, like $5,000.
Yeah, $5,000 a month.
Which is still a great income, right?
Which is great. Yeah.
Better than some people.
But yes, yeah, for sure. And so imagine having the $5,000 a month as your qualifiable income on your business bank statements or your personal bank statements, and then adding a $2,500 a month extra because of the rental property is still going to produce income. So it's an investment loan. It's a real estate investment loan. We're not.
That's wonderful that it's hybrid. That they'll take your personal income from your bank statements, but they'll also take what that property is going to generate, and that equals your total.
Yeah, they're not going to forget that you're using this as a rental property,
right?
So they're going to include that. They're not going to use the full amount of income.
Right.
Usually, it's between 75% and 80% of whatever the rental income shows on the 1007, and then they add it to your stuff.
That's great.
So that helps.
I honestly didn't know that they did that. That's really cool.
So it's really hard to
learn something new.
And I've got clients that have done 8 or 9 bank statement loans.
That's great.
Because off of a $30,000 a month income stream, every new mortgage that we're putting on and adding to that DTI is only a couple $100 extra a month because we're also adding in
that rental.
Every rental income to every single property to combat it.
Right.
So,
what's the max DTI on those?
50% is usually the going rate.
So 50% debt to income. Okay. But they're also taking the rental property income, so that's great.
Correct.
Now, whenever they're doing that, are they looking, when you go to get the next loan, are they looking at your actual revenue from the rentals, or they're still looking at projected? Let's say that you said one guy has bought, let's say 10 with you, right? And he's still under that 50% DTI because of the rental income.
Yep.
So are they, when they're analyzing to give him the 11th property, the 11th loan, are they looking at his actuals from his rental properties, what they've actually been producing?
Yes and no.
Okay.
If you've owned that property for more than 12 months, they will not use a 1007. They're going to use historical data.
Okay.
And they want to see, is that monthly payment on your credit, between me and you, that other mortgage from a year ago won't populate on your credit.
Right.
So it's not even going to be there.
Okay. Gotcha.
So we don't have to combat anything.
Gotcha.
Because it doesn't exist. So because whenever you put these investment loans under your LLC, it's an investment loan.
Right.
So they're not going to populate on your personal line of credit.
So it really doesn't even matter what those properties are performing.
No. But if you are doing multiple within a couple months or 6 months and we're using the same lender, the lender is going to be like, hey, and this is an exact scenario that I'm in. I have a client that's doing one bank statement loan every month for the last 6 months. They know about all of those because they underwrote all of those deals.
Right.
But they use the 1007 on all of those previous because they haven't been rented for a year.
Yeah, they don't have that 12 months trailing.
Right. And they still have the 1007s from the previous properties. As long as you stay with the same lender. If the next month we use a different lender for bank statement loan, they kind of won't ever know anything about it because it won't ever populate on anybody's credit report.
I understand.
So it's when you use a repetitive or the same lender for a repeat product where they go, hey, we're going to have to still calculate those other monthly mortgages because we know about them.
Yeah.
You know, we're not dumb.
Right.
You know, we've seen these guys before.
Material facts.
Yes. Yes. So, but they still use the 1007 on those to answer that question.
Okay. That's good.
Usually up to 6 months. After 6 months, then they sell those loans off and they don't even know about them anymore. So they kind of forget after 6 months.
Gotcha.
So,
Sean.
yes.
So what are you seeing that no one is talking about yet in investment lending?
The big thing that I think people are missing investment lending is utilizing the product on hard money or your DSCR or whatever lending product you're doing, seller financing, owner financing, capital investments, is really driving the loan product to its maximum capability. There's some clients that I have that you can pad, you know, on a fix and flip loan. We were going to finance 100% of the renovation costs. So one of their strategic goals is, you know, they pad an extra $20,000 into the scope.
For carry?
To
help cover the carry?
Well, some of that things may be for whatever purpose they may need.
Yeah.
A large part of what my clients are doing is for furnishings.
Because they're doing the short-term rentals. Right.
Or throwing it for, you know, the pad split idea or the rent by room, the co-occupancy. You know, after it refinances, now they're using that extra money to throw up extra walls or throw in the thumbprint scanner, you know, door handles to make everything secure for co-living properties. But, you know, it is a strategy where if you have you're your own general contractor on these deals. So when you write your own invoice from yourself to yourself and you supply it to the hard money lender to draw, you can pay yourself to be a general contractor. You know, you don't have to have a GC license. You can subcontract all your own deals. So they know that the roof is going to cost $15,000, but they wrote an invoice to themselves from their GC company to themselves, the homeowners, for $20,000 for the roof because that's what GCs do anyway. And they take that gap or that padding and they put it in their pockets to cover the carrying costs on mortgage payments for the rest of the loan, furnishings for future material costs to keep the ball rolling.
Unexpected costs.
Yeah.
That's so really interesting. So what I need to have, like, let's say I want to go get a fix and flip and I can come to you to get 100% financing on those.
Yep.
So I get 100% financing. I then need to have a separate LLC or entity to be my GC invoicing.
Not necessarily.
Okay.
You can just do it under your personal name, essentially.
Oh, okay.
I mean, there's, you know, a gray area there of you can be your LLC that you bought the home under. So you can't buy a hard money loan typically under your personal name anyway.
Right. It's got to be an LLC.
It's a business purpose loan. So you can use the same LLC to
invoice as the GC and invoice
to your own self as the same.
Buy the property.
Yeah.
Right.
So, you know,
I didn't know that. That's
Invest
great.
With Nikki LLC is going to write an invoice to Invest With Nikki LLC, who's the owner of the home.
Right.
You're your own acting GC. That's the invoice that they're going to go off of.
So the lender doesn't care that I'm not a licensed GC?
No.
Wow.
Unless so they may require, like if you're adding square footage.
If you're doing like structural or like that kind of change,
they're going
but
to
not cosmetic.
They're not going to approve.
Right.
If you have, you're going to add bathrooms, add a lot of square footage, they're going to want to say, okay, who's the licensed GC on this? Then you can go, you got to find somebody because they're not going to allow you to tear down properties. Like you got to have a game plan.
You got to actually know how to put the property back together.
Exactly. So, but no, you're, lipstick on a pig or, hey, you're quick, freshen up, fix and flips to turn to STRs.
Yeah. I mean, we're doing a lot of those.
Yeah.
So we're getting to the end of our show, but I think we'll have to do another show because we're doing a ton of these deals right now where we're buying them, these tired assets. Like we've got these, like monster beach houses or historic homes that are just like so dilapidated or uncared for, just have so much deferred maintenance and just haven't been remodeled. In Florida, we've got a lot of aged inventory. So right now, the way that we're really getting a lot of deals done together is we're buying properties that are tired and then we're renovating them. and then we're repositioning those loans, and then we're going to rent those bad boys.
That's
so
right.
it's like, not only are we getting, there's two exits there, right?
Yeah.
There's the,
Always have two exits.
Right. We're doing major value adding a ton of equity by upgrading the property, but then we also can keep that property, hold it, reposition it, and cash flow it with short-term rentals. And that is like crushing it right now. I mean, just this year, I think I'm going to make my clients, profits about $6 million from them, just like the profits. I'm not talking about their cash flow from their rentals.
Yeah.
I'm literally just talking about the value add deals that we're doing.
The equity
and multiple. I have 4 deals right now where they're going to walk away with $1 million profit on the value add. It's probably going to be more. I'm being conservative here. So this is a major play. And it's definitely something that you go and you find aged inventory, you find a good deal sourcer, you find a good lender, you start to build out your team, and you can absolutely crush it.
Oh, yeah.
So and a lot of my clients are like doing those deals, and then they're 1031 exchanging those into bigger assets, right?
Yeah.
So this is
all tax free on the 1031 exchange. Yeah, it's building your fire.
It's absolutely building the fire. I'm so excited to have you today.
No, thank you for having me. This was great.
Yeah.
I could talk to a brick wall, by the way.
Well, thank God I'm more entertaining than a brick wall.
If you got
right?
headphones and a microphone, I am here. So
yeah, we're going to be doing more stuff together. So stay tuned. I mean, Sean is the sponsor of the Invest With Nikki podcast, and he is my go-to broker for all deals. So if you're doing a deal with me, you're absolutely going to get to meet Sean. And Sean, tell them how they can find you.
Yeah, you can find me on Facebook, obviously. I have my own website, Invest With Sean LLC, or investwithsean.com, where I help investors with an online mentorship program that's not $5,000 or $10,000.
Thank God.
You can sign up for $50, less than that.
Nice.
Yeah, I'm trying to, I might run some Black Friday specials here,
Oh, Black Friday's gone.
I know. Well,
we're like coming to Christmas.
I'm trying to figure out that price, but it's going to be no more than $50.
That's great.
You get all the calculators on how to underwrite your deals, how to, cost seg your short-term rentals, like all those calculators. But also it's a 2-3 week, 1 month process that if you take the time and diligence on get online, sign up for the program, and it's just me talking to you on YouTube about all the tricks in the trade. How to save money in your pocket when you're closing on a fix and flip. Pay for your homeowner's insurance on a credit card. Keep that money in your pocket. And then
get the points too.
Get those points. And then whenever you go to refinance, you just pay off that credit card and you get reimbursed with whatever the policy wasn't used. But it's kind of
all the little tricks.
All the little
that.
tricks.
And that's such an affordable price point. I mean, anybody can do that.
Anybody, yeah.
So, and just to be clear, his name is spelled SEAN.
Yeah, the right way. That's
the right way.
Yeah,
the right way. So investwithsean.com. And what's your name on Facebook? How can they find you?
Sean Bailey. My Facebook page is Sean Bailey Real Estate Coaching, or SB Real Estate Coaching, where that's kind of where the same YouTube videos and the Riding With Your Broker, where I just talk about, all things real estate, all things specific to the lending, the kind of the tips and tricks. But yeah, no, I'm passionate about what I do. Thank you again so much for having me on here.
Yeah, thank you.
Of course.
We'll be together again soon.
Oh, yeah.
Yeah.
Probably.
All right, we're out. Thanks for listening.
Thanks, guys.